Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, December 16th, 2019. In this video, I want to go over the energy sector, and what we'll do is have done a couple videos lately and quite a bit of commentary on the energy sector, saying that's, in my opinion, the most bullish-looking sector of the S&P, of the 11 sectors, that is, within the S&P 500. So we'll talk out just a quick couple words on the market, and then we'll look at a couple things we haven't done lately. I'll touch on those charts of XLE, XOP, and XCS again. Not going to do a deep dive into all the individual companies. There's just so many out there right now that stand out. So I could sit here and do an hour-long video covering probably 100 different energy stocks. There's just a lot in that sector. So again, the ETF is one way to do it. I've thrown out a few individual names. And I will follow up any standouts. I'll post those in the trading room on the homepage. The other things I wanted to cover today, a little bit different, are the related sectors that might rally. There's a couple of solar stocks as well as lithium. So pretty much the common theme here is energy, anything related to energy. Lithium has nothing to do really with crude oil or natural gas, but of course what happens is, birds of a feather flock together. Related industries tend to move with the other ones. Solar stocks tend to move up and down, not always, but quite often with the energy, I should say the oil stocks. Why is that? Well, solar is a competing energy source. So if oil gets very expensive, costly, there's more of a shift. You start seeing the governments, going to incentives and subsidies for the solar industry when oil prices are really high. But oil crashed in recent years. You didn't hear much about that anymore. There wasn't all the outcry for getting away from our dependence on crude oil. Of course, when it's cheap, everybody's happy, including the government. So anyway, I just wanted to mention why those things tend to run together, even though crude oil and lithium or solar energy really are not directly related. Okay, enough on that. Just to do an update on the market, as I mentioned this morning, it's almost becoming trite to do an update on these, the equity markets. They continue to walk higher. We don't have any sell signals. The closest thing we had to that was that bear flag a couple weeks ago that played out. But I do want to point out this chart here. I didn't follow up with, or I didn't post this in this morning's charts I'm watching. I went through mostly the futures. But here's that 60-minute chart of QQQ. The last update, we did have a divergent high when that bear flag played out, and that was, of course, the biggest drop that we've had in weeks, if not months, and that was about a 3.5% drop. From there, we hit the measured target of that bear flag pattern. We've moved up, and we still have a divergent high on the 60-minute chart. In other words, this divergence that was in place has extended, and if you take the divergent line, that's where I had it before, it's nice and clean. You extend it out, and that's where we're at right now. So we'll see. And you have now the makings of, you have an uptrend line or a potential uptrend line here, so you have the making of another wedge, something to monitor. But again, the trend is up, and you have to give it the benefit of the doubt. I think I color-coded similar lines on the future, as levels to watch that could trigger the next pullback. Now, with that being said, when any security, including the major stock indexes, when they're at new all-time highs, there's really you really don't have a lot of targets. You don't have any overhead resistance level in which to target. When you have a clear chart pattern, sometimes you'll have at the high levels some type of bullish continuation pattern in which to apply a measured target. But when you didn't really in this case, you just kind of broke out to new highs. And I just wanted to say, short of using Fibonacci projections and maybe a couple other niche things out there to try to see how far the market can go, there's not much you can do. Just recognize the trend as being bullish for now, and I'll continue to post levels to watch, but you're going to see mostly, you'll see almost only support levels below, again, because we're at all-time highs, so you're not going to see the overhead resistance levels because there aren't any. And here's SPY 60-minute chart. It has a similar technical posture. There's an uptrend line. There's the divergence. We had divergence here. I could add it. I had the notes on QQQ. It said DH, meaning divergent high. Had one there, and we just extended it there. So again, levels to watch right there. The uptrend line. And then that about that 311-ish level right there should probably contain any pullback if and when we get it. But right now there's seems to be almost a blow off top mentality, possibly going on here in the market with this, lately almost I don't call it a vertical rise, but we're up pretty good today, and we built on last week's gains. There's a little flagging there, a little consolidation. You can see it. It looks like this: a little up move, called a flagpole. Little sideways action, call that a bull flag, and now a breakout. So that's what's going on there. And maybe we come in and backtest it at a high level, backtest this trend line, I should say, at a higher level. That's certainly a possibility. But again, let's get away from that right now, and let's dive into the energy stocks. Again, a quick overview on. Well, let's start out with the energy. The two main ones, crude oil and natural gas, because that's what's going to determine where XLE, XES, and XOP go. Remember that most of these companies, when you're pulling oil out of the ground, natural gas is a byproduct of that. So these, a lot of these companies have their hands in both. Just like a lot of the gold mining stocks that we follow, it might be the name of the company might be, blah 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 gold. But they also pull silver out of the ground. They're not going to pass up, a vein of silver they hit when they're mining. So in the same way, a lot of these companies are dependent on both oil and natural gas prices. Yes, some obviously more so than others, but there it is. So crude oil is right now, at least by USO, the ETN. This is one of the more popularly traded ETNs to track crude, right at the top of that 1265 zone, taking out the trend line. The trend line, I don't give it the highest weighting because I have only 1, 2, and 3 reactions. That's the minimum, in my opinion, it takes to validate a trend line. 3 reactions off there, and this wasn't much of a reaction. We kind of consolidated on it recently, so I'm putting a higher weighting on this this trading range, and we're right there. You'd want to see for the bullish case is a clear breakout, some big green candles, and clearly moving away from that level. So I'm still cautiously bullish. I still like the energy stocks. As far as the 11 sectors in the S&P 500, I think there's more potential than just about any of them out there. And I do think that if the market continues to rally into the end of the year and beyond, meaning, or well into 2020, then I think you'll have more bang for your buck in the energy sector than just about any other one out there. I think the only thing that's probably going to put a cap on this rally right now is a correction in the stock market, because what we're seeing, somebody made mention on one of, I think, on the comment section on Friday's post, it looks like maybe an inflation trade is in play, and I think so. Proof of that would be, this was in my reply, I did the recent commodity video. Of all the ETFs that I track, I have a commodities watch list with agricultural commodities, oil, crude oil, things like that, both hard and soft commodities. And this ETF covers them all. You have the hard and soft commodities, and you can see it's going parabolic recently. Very, very strong, steady advance. Nothing but green candles, right? Look at this. Not a single red candle now for weeks, and that's off the move off the bottom here. I've been highlighting that one for months now. Not a huge gain, but a big gain for commodities. Remember, it's an ETF, like a mutual fund. So you have the good and the bad. It's spreading out. And so what my response was, we're seeing a broad-based rally in commodities. That is inflationary. When commodity prices start going up, make no mistake about it, that is the core right there of inflation. Just about everything else will trickle down, and eventually you see rising commodity prices, it trickles its way down to everything else. People's cereal starts getting more expensive. The steaks, hamburger, chicken, whatever you're buying, old gas to put in your car. And so inflation goes up, people are going to start demanding increases in salary. It's inflationary, and it trickles its way throughout the economy, so make no mistake about it. This is going to be the byproduct. And if you continue to see this, what you're going to see, mark my words, it may take a few months to happen, increasing criticism for the Fed for just what they've done every single point in time. As long as I've been around in the business, even coming out of college as a business major, I've always remember the Fed being clearly behind the curve. They they tend to keep the pedal to the metal for too long. They did it, back in, the last housing crisis. They did it back in 2000 after the dot-com bubble, or leading up to that. And so here they are, keeping rates low. And the risk, I think, and I'm digressing now, is that by the time they realized, because they've been citing the reason, even though they met all their metrics going back from the financial crisis, they had metrics that they said once they hit, they would back off the quantitative easing and the uber low rates. Well, they didn't do it. They hit their unemployment figures, price stability, all of them, check, check, check. But they kept the pedal to the metal for risks that they're worried about may happen. But yet the economy and the stock market continues to grow. So where I'm going with this is I think the risk is runaway inflation that's out of check. And if you get behind the curve on it, it's usually too late when you start applying the brakes. And that's, again, been the trend. So let's watch this. Let me not, I don't want to sound too dramatic, but it's something that I've been watching for a long time and expecting. And if you see right now, we're seeing a broad-based rally in just about all asset classes. You're seeing everything go up. Even gold, which should be dropping right now, I covered that in today's update. Gold is a risk-off asset, and what you're seeing is a stock market, making new highs, as I just showed you, new all-time highs, continues to rally now for weeks now, even months going up, and yet gold. Yeah, it has corrected, but it's not going down anymore. It's been in a sideways range. It's been in this multi-month consolidation range, and gold should be going down. So what I think is happening here, I think there's cross currents. You have the inflationary forces, because gold, is also at times used as an inflation hedge. You saw that back in the 70s with the runaway inflation. Gold did great. And so I think you're getting those cross currents there, where gold should be dropping due to the strength in equities. That risk-off asset, risk-off premium should be melting away in gold right now, but it's not. So whatever. That's one thing I think may be holding up. Of course, I'm also made the case for a major top in the U.S. dollar. That's also helping gold as well. And so that's it. Now, kind of did go all over the place here, and I told you the focus of this was energy stocks and related sectors. So let's just look at that real quick, and we'll try to wrap this up. XLE took out this secondary downtrend line right there. 61.45 is resistance. You see that previous reaction high. You see a gap right here. And you can go back. You can see those reactions right there. So XLE is at resistance, but the chart continues to firm up. Remember, the bigger picture is it put in a divergent low here, and again here. There was a double bottom, and you had positive divergence right there at that first low, and the divergence continued to build. Even though prices made an equal low, you had a higher low on the indicators there. So that is divergent low number 2. And so far it's rallying, constructive looking chart. And again, I think barring a major drop in the stock market where you get a broad-based sell-off and everything goes down, I think this again is one of the best looking sectors. You can see some potential targets. I'll have to sharpen my pencil on this, but again, that's just XLE, which and you can note this, it's up 1.71% today, which is by far the strongest performance of the 11 sectors in the S&P 500. I'm glancing those on another monitor. It is again up the most, as like I said, most bullish. I would think when you see the market rallying, and if the market continues to rally, I think you'll continue to see that outperformance there. My top pick, let's go in reverse order, was XES, where I think you get the most bang for your buck. I said quite a few times recently, up 2.9% today. Beautiful chart, a better looking chart, and just know these companies when the energy stocks rally, plus the charts as collectively, when I went through a lot of the components, stood out as much more bullish than say your ExxonMobil and Chevron in those companies. So 2.9% on that one. XOP, I told you, was my second favorite, and this one you can use GUSH, G-U-S-H, if you like those 3-time leverage ETFs, up 3.4% today, and right at the downtrend line right there. Strong divergences building, downtrend line plus 2274 resistance, and looking good. If it can make a solid breakout above that downtrend line, you can see some early targets. Let's just look at these right now. Let's say we'll take it one day at a time. I don't see any reason. I think I made mention to recently, and if I didn't, the way to trade these right now, I think, is, position, get in there as a potential bottoming play. That way you can, allow relatively wide stops and let it run. This would be if we rally into year end and beyond, into early 2020, then we could see XOP come all the way up here. That's about a 49%, if I measured that right. Let me do it again. If we get all the way up here, that's about a 40% gain. Even to that 2787 target, that's about a 23% gain. And then XES, similar chart, a lot of gain potential. And it all depends, again, how long the music keeps playing. That's the analogy I'm going to use. When you have a rally like this, with overbought conditions, the momentum's strong, you don't have any sell signals, so you either stand aside as far as the equity indexes go. I like to play the best looking sectors, but if you're playing the market as a whole, or even this sector, as long as the music's playing, you're fine to be in there. When the music stops, you don't want to be the last one standing without a chair. That's how the game of musical chairs works. They go round and round, and they stop playing the music. They take a chair away each time, and whoever the last one to sit down doesn't have a seat, you're out. What I mean by that is if you stay too long to the party when you have this kind of euphoric buying going right now, the reversals can come pretty fast. And you can give up a lot, if not all of your profits by the time you realize. So again, right now everything looks good. That could change, but until, like I just showed you in the beginning of the video, SPY, QQQ, we have those uptrend lines to watch, and they're comfortably above those right now. Here's what I'm referring to. You can watch those, and they may burn through these divergences. That's another thing. Again, just to loop back and get back on the markets for a second, we'll get back to the energy stocks. Somebody asked, Randy, when will these divergences be taken out? How much more do we have to go up? I said it's a great question, but it's actually, there's no straight answer because there's two variables involved, time and price. Price would be easy. I could, not to give you an exact number, but in other words, if we went straight up from here, like this, and there was no time component, time is this way. Let me grab an arrow tool. There's your time axis, and there's your price axis right here. Price axis, time axis. So if price went straight up from here, I could say, okay, well, we go up, and then we're going to take out the divergences if we go up X amount, or roughly. However, there's almost an infinite number of variables or ways that the market can play out. If the market were to correct, then that's going to obviously change things here. If the market corrected, then that's a correction in price. If the market corrected in time, let's just say it moved sideways. Most may not realize this, but you might think that the indicators go sideways. That's not the case. If the market goes sideways from here, the indicators drop. It'll turn down. Why? Because when you have upside momentum, these are momentum indicators, and all of a sudden you have a positive slope on prices, and then you go to a flat slope. That's a change in momentum, and these will go down. And odds are it'll be a combination thereof. So we can go straight up, burn through those divergences. We could, move sideways, correct a little bit. There's just a lot that can happen. And at the end of the day, the most important thing, and as I said in there, divergences are not the be-all, end-all. You do not have to have divergences to mark major tops and major bottoms. They certainly help indicate one is coming, and likewise, I've seen, it goes on to what I just said, I've seen divergences get burned through, especially with blow-off tops, and then the market go on to reverse. So again, it's just one of many things that gets factored into my analysis, but I wanted to make mention that whether or not the divergences are burned through, doesn't really say. I guess what I'm trying to say is if we burn through the divergences, it doesn't mean, okay, wow, the market just has an all clear, it's burned through multi-year divergences, now it's going to go up for the next few years. We're in a new bull market that has, 2-3 more years to go. It's not like that. It would certainly chip away at the bearish case if they were burned through, but it doesn't eliminate it. All right, so now a few stocks that I wanted to cover, and let's start with the solars. There's not a lot. So one of the sectors I wanted to look at was solar stocks. You can go to the solar ETF is TAN, T-A-N. And you can see, like the energy stocks or the gas and oil stocks, they're moving up, even though these are competing energy sources. Remember, they're direct competitors, between crude and solar energy. But yet you see that rallying for the reason that I mentioned before. You're seeing crude prices go up, and because of that, you're seeing these stocks rally in sympathy. And it may be a short-lived rally. There's not a lot on tan that stands out to me. I just want to show you a couple individual solar stocks within there that look compelling. One of those is Run. That's the company name is Sunrun. Run just broke out nice clean downtrend line, positive divergence. This gives you a bullish falling wedge right here, and it just broke out and didn't just limp through. Look at that big impulsive breakout on what was that, Thursday. A little consolidation on Friday, maybe bear flag, bull flag action. Probably see that better on a 60-minute chart. Let's see if we go there. It looks like that. You can see here's your flag, there's your flagpole, and impulsive breakout today. And if I could add the line, well, you just take the distance of the flagpole. So if I grab that trend line there and add it on to the lowest part of the flag, that would give your measured target, and that comes in. Having a tough time today. Let me get rid of that line and add a horizontal line to show you roughly where that target would be. And I like that because it lines up with price resistance. So 1481 would be the target there, and that would still give you another about 5% on Run right there if it is hit. And there's a potential downtrend line that was just taken out and back tested. So that's one of my favorite solar stocks right now. And of course, there's a potential for more. If the energy stocks continue to rally well into the end of the month and beyond, like I said, be careful. The music stops, and probably a good chance it will sooner or later. This is getting this rally more so, not the rally, it's not the strength. I've seen much stronger rallies with bigger gains. It's more of the sudden shift in sentiment that I've seen in just the past couple of months from wide expectations that a recession was likely to, I'm seeing articles and excerpts saying buy stocks, there's absolutely no risk in the market. I'm seeing things like that right now, and that's a little bit scary. When you see that and people are saying there's no risk of in the market, no risk of recession, that's usually when you want to check it. Markets like to climb a wall of worry, and most bull runs end on euphoria. And so I don't know if this is euphoria yet, but again, I'm being a little skeptical. All right, let me give you some other stocks and we'll wrap up here. SPWR, another solar I like, is SunPower Corp. And you can see a nice breakout the other day, this downtrend line with an impulsive green candle, and nothing but follow-up so far. I know these price levels aren't marked. I've had a lot. This chart was marked up. I only added this trend line recently. I've had a lot of these levels here from the past, but there's some potential targets you can see here as I turn on the levels, and I'll have to sharpen my pencil on this one. Update the trend lines or the resistance levels. But I think up to maybe that 1020 level, as long as the music keeps playing in the energy stocks, meaning XLE, XOP, XES. So that's SunPower. By the way, positive divergence on both of those, Run and SPWR. And finally, roll into the other one I wanted to get to, Lithium. This is more of an update. I did an extensive video on the lithium stocks a couple months back, mentioning and if you like to keep things simple, want one size fits all, LIT. This is the Global X Lithium ETF, gives you exposure, and I'll tell you it's a pretty efficient way to go, because a lot of lithium companies are not, the U.S. is not a major producer of lithium. You have other companies, Australia, Canada, China, if I'm not mistaken. So a lot, South American countries. So a lot of these individual lithium companies, many of those are outside the U.S. and some of those, although a lot of them do trade, they have shares that might list and trade on the U.S. exchange. Many don't. My point being that when you go with LIT, you're having a global exposure. You're also, this ETF is holding companies that you or I may not be able to buy, unless you have permissions with your broker to buy, some of these foreign companies. So it's been, moving up. I mentioned this divergent low back here in August. It's been moving up, took out that first downtrend line, took out the primary downtrend line, which is yellow, made an almost perfect back test. You can see it right there. And so far, just a constructive chart, and again, it meshes with the whole theme of this video. Lithium is, consider it. Others might, I don't know if it's considered a subsector of the energy sector. And again, these are not just, by the way, the stocks in my watch list here that I'm about to go over, and I believe those in this ETF, are not just lithium mining companies. They're not just, mining lithium. You have all types of companies. Producers, you have Tesla is in my watch list, and it may be part of this ETF. I'm not sure. Why? Because they, big part of their the profits come from batteries, and they manufacture their own batteries for their cars. So you have all different types of companies in here. Again, I just want to mention that. And this one, you can see next target's coming up at 27.55 resistance, and these are the same targets I believe that were outlined in that video that I did a couple months back. Just wanted to make mention, perfect breakout back test so far. I added this uptrend line since the last chart. So there's a level to watch if you're long LIT, or you want to get long and you're looking for the most objective area to go, maybe long on a pullback with a stop somewhat below that trend line and or any of these resistance or support levels. Alright, next up, a few of the lithium stocks that I like. Let me grab another watch list off another monitor here and go through these in no particular order. I want to just say this so I don't have to repeat it on each and every stock. As I go through these, look at two things. Look at the price of the stock. This is a penny stock. The lower the price, the higher the risk typically. There's not a hard and set rule, but anything under $1, even stocks under $5 are usually pretty speculative. Years ago, I don't know if it's still out there, Fidelity launched the low price stock fund, and their strategy, they would only include stocks that were trading under $5 a share. There's higher growth potential in those lower names, but higher risk. It was a great performer back in the 90s, early 2000s. I don't know if it's still out there now. The other thing to look for, see these spotty little candles? See, these are normal candlesticks. That tells you that this is a thinly traded stock. When you see these type of candles that look like just little blips without many, tall candles. And so therefore, very high risk, especially the more thinly traded. Use limit orders or IB algo orders. If you don't know, if you have interactive brokers, they have adaptive algorithmic orders that will try to fish between the bid and the ask and get you the best fill. Some of these over-the-counter stocks, they won't do that for you, but on a lot of stocks they will. And okay, so the chart here, the common theme on a lot of these, nice bullish divergence, just like the oil stocks too. Some of these have already broken out. This one hasn't. There's a potential downtrend line. Let me go to the next one here. It's not my favorite. I just kind of wanted to get all the details out that I was talking about as far as, here's another one, penny stock, but a nice looking chart. Candles are a little bit more regular. A lot of these will still be thinly traded companies, and this one's American Lithium Corp. And there it is. Break above this downtrend line should bring you up to any or all of these levels. I'd say first target's around that area, that's 17 cents a share, and these are all potential targets there. So there's one that hasn't yet broken out, but you can see had a divergent low right here. I probably covered that in the last video. It broke out, and it may not look like much. These little penny stocks, it's a 25% return just from the breakout. It rallied 25%, and that was just a bear market rally. Now put in a larger divergent low. It extended the previous divergence right there, and next buy signal to come on a break of that trend line. So you want to set an alert, and when it pops, ideally look for increased volume on the breakout, and give you an early target or resistance level. It has to clear right here about that 9.5 cent share price. Tesla. All right, Tesla, in fact, is the only one in this watch list that I would I'm eyeing for a potential short. The rest are all bullish and looking like longs. Why? Well, Tesla, if you go back on the site for a while, I've highlighted for years these trading ranges in Tesla right here. I just jumped over to a weekly chart, and Tesla has traded, after the IPO it had a big run up, and then it consolidated for several years. These are the year breaks down here, 2014, 15, 16, 17. So there's a multi-year consolidation, that range. It broke above the range. There's the line that defined the top of the range, or the price level that is. There's the top of the range right there. And when it broke down, that was highlighted at the time, boom, went right back down to the bottom of the previous range. So it takes turns, at least it has in recent years, trading between these ranges. And when that happens, well, anytime you have a security in a range, you either, if you're long, you sell, close your position at the top of the range, and or short at the top for a move back down to the bottom. That's it. So here's your close longs or go short level, or both. And this is cover shorts and go long. And so we broke to the top of the range, and I would be surprised if we didn't have at least a reaction, at least a pullback to maybe halfway, the midpoint of the range. That's you can often trade among, around the midpoint of the range. So at the very least, it may provide a pullback trade, and possibly more if it goes all the way back down to the bottom of the range. And again, when I go to this daily chart here, you can see those ranges. Here's the top of the range. Tesla has offered just multiple shorting ops in recent years. Hitting that top of the range, you can see divergent high, divergent high, divergent high, divergent high, and right now you can see it building, currently have divergence in place. A little more upside, ideally get closer to that 388-ish level, and you could even take a shot there with a stop somewhat above, or wait for a sell signal, which I'd have to add some lines, maybe get a, let's see if we can add an uptrend line right here. Yeah, there's your wedge pattern, boom, break of that, and probably swing it back down here to about that 325 level. It would also help, let me say this, it would also help to have the market confirm, if the market's in this rally mode, especially if we get a blow off top into December or January, shorting anything, especially well-loved, stocks like Tesla, Facebook, Amazon, Apple, you're really swimming against the tide there. So ideally you want the market to confirm. So maybe Tesla, for example, you get up there, you get a short entry there, half a position around a little bit before 388 with a stop somewhat above, and or add to that position on a break of the trend line, especially an impulsive break, or even on a break of that 361 support. And then at that point, let's say the market breaks down, gives you a pretty solid sell signal. If that was the case, then you might want to hold that short on Tesla a little longer, and just let it ride for the time being, as long as the market's dropping. Maybe you go all the way back to the bottom of the range. However, if the market's rallying at that point and still looks strong, you'd probably want to take the quick buck on Tesla and get out. That's the way I'd look at that one. Okay, and the rest are all longs in the lithium sector. So here's FLV. If you see a .V, that's on the Canadian Venture Exchange. So if you're Canadian, this one. And you might have some of these, I might, as I go through the list, I might have them in US shares. Let's see, Frontier Lithium, FL.V, and that's it. So I don't see, oh, there it is, Frontier Lithium right there. So there's your US shares if you want to trade it. HLKMF. F means foreign, so that's a NASDAQ or a NASDAQ OTC stock with the F indicating it's a foreign share. As I just showed you, that's a Canadian company. The primary shares are based on the Canadian Venture Exchange, which is kind of like our small cap index. There are more speculative companies there in Canada. Let me add that to my list if I didn't already. Lithium stocks. Okay. Next one up would be OROCF. I've highlighted this one recently. This is a lithium stock based, I think it's a, if I remember right, it is a, and I may be wrong on this, I think it's an Australian company, but they have most of their interests. They have interests in Argentine mines and other lithium properties there. Either way, you can see a description there. You can look it up. Yahoo Finance is a great source. Type in OROCF space Yahoo, it'll bring you to the, you'll get a Google search, it'll bring you in there, and you could read about the company. But I like this one. Look at that nice downtrend line, divergent low right there, and it's poised to break out now above this, about the 185, 186 level. Should do the trick. You had a little pop above that level there before, but that took you to the downtrend line. This time around, you have both the trend line and price resistance coming in together, and I think this one has plenty of potential to run as long as the music continues to play in the energy sector. About 22% if it hits that target, and about 45% if it hits that target zone up there. STLHF, Standard Lithium, again another foreign company, breakout backtest, looks objective right here because it broke out and it's backtesting the trend line, and it has support just below about 59 cents or so, and I don't even have all the targets marked up, but I'd shoot for these, at least these reaction highs right there would be your first two logical targets. Maybe move all the way up there. It just depends how long the momentum is in the sector. And the other thing too, the more of these that break out, the better the chance you're going to see a sustained rally. These are potential bottoming plays here. Last time this one broke out right here, it rallied about 40%. Right now we have an even better downtrend line to watch, nice and clean. So break pretty much to keep it simple for you. If you replicate these trend lines if you can, use log scaling, but to keep it very simple, if it took out last Wednesday's high and even Thursday, it pretty much had about equal highs right there. That will have also taken it above the downtrend line. And when you have previous reaction highs like that, the safer bet is to wait for these previous highs to be taken out instead of jumping the gun on a trend line break, because some traders will sell the stock there at the previous reaction highs. So if it can break out above about 326, it should run, and you can see some potential targets up here. Let's just say right now, it has the potential to come all the way up here at about 440, 477 or so. LTM, CF, Lithium, Chile, failed breakout there. Not one of my favorites, but same story with all these, divergent low. BYDDY, I believe this is a Chinese company if I'm not mistaken. They do batteries and other things like that. Break above this trend line there. You have this one's messy. I'm going to remove that trend line now. This is the trend line that I'm looking at. So break out of that trend line, and I'd say a nice swing target be up somewhere around right here, about $11. That'd be a nice lift from where we're at now, about 14% or so. ALB, breakout back test. You can see some potential targets here. That's a specialty chemical stock. Not sure exactly what they do. I already covered LIT, the ETF. SQM, I like this one. I believe I highlighted it recently. Breakout here. It traded in this sideways range, broke down, but it then back tested the trend line. Successful back test. Took a couple back tests, then boom. Been moving up since. It's now in the back into that middle of that support zone. Next target about 28.78. And then you have a downtrend line here that's likely to come into play, as well as some other overhead levels. ENS, not one of my favorite, but it's in a nice uptrend. You can buy pullbacks to the downtrend line, the uptrend line with stops not too far below. I already covered that one, and I think that's it. I think that's most of what I wanted to cover. NLC.V, another Neo-Lithium, that's a venture exchange. LBY.V, Liberty One. You can see the same story here with a lot of divergent lows. I'm getting into some low price ones here, so I'm going to stop the video and get it out to you guys. All right, this has been Randy Finney with Right Side of the Chart. I hope you enjoy.